slide. Give me some emoji. Okay, thank you. Uma, fix your slide. Good day, everyone, and welcome to today's class. This is week 2, session 3 of our training, and today's topic is trading basics, risk management, and psychology. Trading basics, risk management, and psychology. Okay, so important disclaimer: this presentation is for education and entertainment purposes only. It is not investment advice. Never trade with real money without proper adult guidance and education. This content is designed to teach concepts, not to encourage actual trading. Welcome to the exciting world of trading. This presentation will learn how successful traders protect their money, 1, manage their emotions, 2, and make smart decisions, 3. Think of trading like a video game right now, where you need a strategy, discipline, and a solid game plan to win. So the mind-boggling question now is, what is risk management? What is risk management? Risk management is like wearing a seat belt when you ride your bike or bicycle. It protects you from big losses. Imagine you have $100 to trade. A smart trader doesn't risk all $100 on one trade. Instead, they risk only a small amount on each trade, maybe $5 or $10, which is either 5% or 10% of the total value. Why does this matter? If you lose one trade, you still have most of your money left to trade another day. It's like having extra lives in a video game. The goal is to stay in the game long enough to win more trades than you lose. So there are 3 rules of a professional investor. These 3 rules was generated from a book, An Investor, by Warren Buffett. The author of the book is Warren Buffett. The first rule is protect your money in that book. Protect your money. When you have funds in your account, the first mindset you should have is what? Protect your money. Never risk money you can't afford to lose on one single trade. That's what that means. That rule, whenever you hear people say protect your money in trading, it doesn't mean don't put money in trading. Instead, it means never risk money you can't afford to lose on one single trade. That last statement is very important. On one single trade. If you can't lose that money on one single trade, protect your money. Don't put it in. Rule 2, plan your escape. Before you play the trade, plan your escape. Know exactly when to stop and exit if things go wrong or go right. And rule 3, know your goal. Decide how much profit you want to make before you start trading. Okay? There is statistics in this world that about if we are 100% in this world, like population is 100%. 80% of the population of the world doesn't have goals, daily goals, life goals, business goals, relationship goals, money goals. They don't have it. Okay? Remaining 10% that do have goals, they also what? Wrote it down. So 80% don't have goals. The 10% that made it 90 have goals, and these goals are written down. They know that, yes, they have financial goals, they have health goals, they have relationship goals, they have business goals, they have personal goals for a year, for 10 years, for 20 years, and so on and so forth. And then the remaining 10% that makes it 100% actually have these goals and they execute these goals, not just writing it down, but executing it and keeping yourself focused to achieve those goals. So when it comes to trading, it is the same thing. The 10% in trading, what they have goals, they wrote these goals down and they execute those goals, not minding what. Then the next question in your mind is stop loss and take profits. I'm going to explain it right now. Think of stop loss and take profit like setting boundaries in a game. Before you start playing, you decide. Before you even start playing, before you place the trade, buy or sell, you've already decided my stop loss will be here, my take profit will be here. So stop loss, this is your emergency exit button. If a trade starts losing money, you stop loss automatically closes it when you have lost a certain amount. Example, if I lose $500, sorry, $5, I'm out. This prevents small losses from becoming huge disasters. One of the biggest mistakes of newbies. I've mentored a lot of people in trading, and one mistake they always make is what? They place a trade, they don't put stop loss, they put take profits. The market will be going against them. They'll say it will reverse, it will reverse, it will reverse. Yes, you might have a lucky charm the first time, it will reverse. You might have the lucky charm the second time, it will reverse. But the third time, the fourth time, you cry, you regret. So I don't want you to pass through that pain. Okay? Be disciplined. Be disciplined. Thank you. Straight to village. Straight to village. The trade will take you straight to village. You just see your money to drain off from your account. And the issue there is that you know the right thing to do. The right thing to do is to close the trade. Okay? But due to the amount of money that is lost already, you'll be in between the choice of should I lose it now or should I hope that it will bounce back? Or that situation is dangerous. So there was a day I was with my students and he placed the trade. The trade was going against him. I placed that same trade and the trade has gone against me and closed me out on stop loss. So I didn't know that he was still holding the trade. So it was when we were not eating lunch. He was sweating very, very well. I told him, are you okay? He was just sweating. Told me that trade. That trade that he has not closed it. I told him, let me see. He gave me the phone. As soon as he gave me that phone, I closed that trade. I closed immediately. I closed it. I didn't even mind how much is lost. I didn't mind how much, because my mindset is, yes, we closed the trade now. Probably you lost $40, lost $50, but as a trader, once you still have capital in your account, anything is possible. Anything is possible. Once you even still have ordinary $20, $30, anything, you can still flip that $20 towards $100. You can flip that $30 towards $300. But if you don't have if you don't have $1, you can't do anything. So that's the mindset. I've been through trading and I know that it is possible. You get? So once I saw it, I closed it. I told him, hope for the next trade to bounce the account back. Simple and short. You understand? So please don't fall for that temptation. If I place stop loss, put it and be disciplined with it. Lose the money and lose it happily, because the next trade can bounce you back and make you times 2 or times 3 of your capital. Please have that mindset. The next is take profit. This is your victory point. When your trade makes enough money, it automatically closes and takes your profit. For example, if I make $10, I'm done. This helps you capture wins and not be greedy. Yes, set a target, take it, leave the market, you're done. Then 3, risk or reward ratio. Good traders use a minimum of 1:2. I showed you guys this on our class, the second session class. Minimum 1:2, not 1:1. It doesn't work well with probability. 1:2 or 1:3 ratio. If you want to become wealthy extremely fast, look for 1:5. Okay, this means for every $1 you're willing to lose, you want to make $2 or $3 in profit. It's a fair deal that makes you money over time. The next is position sizing, the secret ingredient. Position sizing, the secret ingredient. It was hand in hand with lot size. Okay. Position sizing means deciding how much money to put into each trade. How much money to put into each trade. This is super important. Let's say you have $1,000 total. A good rule for beginners is to risk only 1% of your total money on each trade. That's $10 per trade. So it's deciding. Okay. So wrong way of doing this is risk $500 on one trade. You have $1,000 and you're risking $500 on one trade. If you lose, you have lost half of your money. You might panic and make bad decisions next time. The right way to do it, risk $10 on one trade. If you lose, you still have $990. You can learn from the mistake and keep trading calmly. Okay. But for professional traders, they might up this game from 1% to 10%. Okay. Based on statistics of your trading approach, there are trading approaches that can give you winning rate of 50%. Like if you place 10 trades, 5 is correct, 5 is wrong. There are winning statistics that can give you 70%. If you place 10 trades, 7 is correct, 3 is wrong. So there's losses are inevitable, but whenever you make a win, it covers for the losses. That's probability. So the compounding magic. When you win many small trades and keep your money safe, your account grows like a snowball rolling downhill. Small wins add up to big wins over time. Exactly. Probability and compounding. I'll still show you guys how that works, okay? Emotions in trading, the big challenge. Here is the truth. Trading is 90% psychology, 10% technical. I repeat, trading is 90% psychology, 10% technical. Even if you have a perfect strategy, your emotions can ruin everything. Let's talk about the biggest emotional enemy of traders. There are 4. There are 4 big emotional enemies of traders. The first one is fear. You're scared to lose. So you close winning trades too early and miss big profits. You close winning trades too early and miss big profits. Or you freeze and can't make decisions. 2, you want, 2 is greed. 2 is greed. You want more and more money. You ignore your stop loss and take profit level, hoping to make even bigger gains. Then 3, confusion. Too many signals and ideas make your brain tired. You don't know what to do. So you make random emotional choices. 3, FOMO, fear of missing out. Everyone is talking about a trade. So you jump in without a plan, just like following the crowd without thinking. So all these things are mistakes of traders, and you need to avoid them. You need to avoid them. Very, very important. You need to avoid them. So journaling your trading diary. A trading journal is like a diary where you write about every trade you make. This is one of the most powerful tools for getting better. Here is what you write down. What to track, why it matters. The first one is entry price. Where did you get in? Was it a good spot? 2, exit price. Where did you get out? Did you stick to your plan? That is for it. Profit or loss. Did you make money or lose money? By how much? Emotions. Were you scared? greedy, or calm? Did emotions affect your decisions? So the lesson here is, what did you learn? Okay. At the end, what did you learn? What will you do differently the next time? Okay. You need to have the journal with you, more like a diary about every single trade you place on a daily basis. Okay. The power of this is, after 10 or 20 trades, you can look back at your journal. You see patterns. Maybe you always lose when you're rushing, or you always win when you wait for perfect setups. This knowledge is gold. Building your trading plan. This is very important. A trading plan is like a blueprint for a house an architect draws. Before you build, you know exactly what you are creating. Before you trade, you should know exactly what you're doing. Your plan should answer these questions. First, what will you trade? Stocks, crypto, specific symbols. Stay focused on what you understand. Two, when will you trade? During certain hours of the day, only on specific days. Consistency matters. Three, how much will you risk? Remember, 1% of your total account per trade. Write down your stop loss and take profit level as well. Four, what's your signal? What tells you to enter a trade? A price pattern, a moving average. Be specific. So, personal trading plan template. Here is a simple template you can use to create your own trading plan. Copy this and fill it out before you start trading. Okay, everyone here, you can as well take a screenshot and use this personal trading plan. My trading plan template. You need to start with trader's name, your first name, and your last name together. Then you fill in a date when you wrote this trading plan. For you can fill in a date for a month. Okay, you can fill in a date for a year. You can fill in a date for a week, depending on you. Okay, and you can have this. You can have many copies of this lying around, and you can put it in a file binder, whereby you can now have like 50 different trading plan pages. Okay, in a file binder. So you now say what I will trade. Example: Apple stocks, Bitcoin, Euro USD, gold. Write it down, and you can put the date. You can say, okay, I want Monday. You can write Monday. Write your name. Write Monday. What you trade that day? Gold, SAUSD. Write it down. The trading hour. When I trading it? Example: I'm trading it by 1 p.m. West African time to 4 p.m. West African time. Okay. Or you can say you want to trade whenever you want to trade, either New York session, London session, Sydney session, Tokyo session, whenever you want to trade, you pick the time. Then total account size. You write down your account size: $1,000, $2,000, $10,000, $100,000. Write it down. Risk per trade. You write down your risk: 1%, 10%, 5%, 0.25%, 0.5%, whatever percentage it is. Write it there, and the amount. You see, it is in dollar sign. It is in dollar sign. So this percentage now, you can then write the percentage here and the amount. My entry signal. How I know when to buy. No, Divine. No, you're not risking 100% on a trade now. That is not proper risk management. That is called full margin. You're not risking 100% on a trade. Then my entry signal. How I know when to buy. Write it there. You can be specific on this one, very, very specific. When the market gets to this particular level, or when the market reacts this way, or when the market creates a MACD, or when all those kind of stuff. Then my stop loss level, you write it down. The price where I will is wrong. You can write down the price. My take profit level, where I will take profit, you write down the price. My risk or reward ratio, is it 1:2, is it 1:3, is it 4, is it 1:5? Write it down. Maximum trade per day. How many trades would you want to take that day? How many trades you want to take that week? Then rules I must follow. And you should always remember, never break these rules. Write it down one after the other. I must follow these rules. I must protect my capital. I must have an exit strategy. I must have a goal. I must be disciplined with my trade. I must not rush a trade. I must be patient for a perfect setup. I must not trade if I don't see my setup, and so on and so forth. There are a lot of rules. Print this out and keep it where you can see it. Stick it to your plan, even when emotions want you to break it. Okay, stick to your plan, even when emotions want you to break it. Try as much as possible to be disciplined and do that. Okay. Okay, your trading journey begins. So key takeaway: risk management protects your money. Stop loss and take profits are your safety tools. Position sizing is equals to risking only 1% per trade. Emotions are your biggest challenge. Control them. Your journal teaches you what works. Your trading plan is your roadmap. So the next step now, you need to fill out your trading plan template. Okay. Start a trading journal today. Practice with proper trading. That's demo money. Learn to recognize your emotions. Review your journal weekly. Always ask an adult for help. Remember, the best traders in the world didn't start perfect. They built discipline, learned from mistakes, and control their emotions. You can too. Start small, stay disciplined, and have fun learning. Happy trading. Okay, so that's the major thing that is very, very important. So I see over here, someone says he's going to risk 10%, 100% of his capital, Divine Eke. And Solomon is encouraging him, fortune favors the bold. Okay, Divine, you have heard it now. Go and try it and share your experience with us. It might work the first time, but over time it won't. Then Emmanuel said, what will be the effect of using a VPN when trading? The effect of using a VPN depends on the type of account you're trading. If you're trading for a broker, they might limit you from accessing your broker dashboard if the region of the VPN you're using is not acceptable to them. Okay. So and if it's a prop firm, they can actually terminate your account. They can actually terminate your account because if you end up using a VPN and the VPN is not constant and you trade the account with the VPN and they detect that you're in a foreign location and the next week you're not in another location and the upper week you're back to the foreign location, they might end up terminating the account if it's a proprietary firm based on experience. Okay, they might end up terminating the account saying that multiple people are trading the accounts. Okay, multiple people are trading the accounts and it doesn't favor a good trading approach. So that's it for VPN. So so I see another question. Tango says, is the risk reward ratio applicable to crypto trading? That's futures. Yes, risk reward ratio is applicable to futures trading as well on crypto. So let us do some practical works. We'll do some practical works now and create a trading plan. Okay. So, but before I dive into creating a trading plan, there is a particular trade we got into. That's the Euro AUD trade. The trade is still running. This was the trade we got into on our session 2. Okay, the trade is still running. This was our entry price. The trade is still running. I'm expected to go up and hit this take profit level. So that means we'll be holding this trade into next week. Okay, and I'll be sharing the result of this trade. Okay, I see another question from Emmanuel. How do we calculate account size? Okay, then with low capital, does the 1% risk approach apply? Okay, so we're going to talk about all those things. How do we calculate the account size? What emotion does revenge trading fall under? Revenge trading is also a part of emotion now. Revenge is an emotion, fear is an emotion, greed is an emotion, revenge is an emotion. Okay, so it's under FOMO is an emotion, fear of missing out is an emotion. Okay, so it's the fifth emotion that is meant to be on that slide, divine Eke. So I'm going to show you guys how do we calculate account size. So and then together with low capital, does 1% risk approach apply? Okay. So literally, I use a calculator called the position size calculator. You can literally go to Google and search position size, Forex position size calculator. You can come over here and search for it. Okay, Forex position size calculator. Okay, let's search Forex position size calculator. You search for it. Then when you search for it, you come over here, we have different types. Like a lot of brokers have their own. These guys have, Okta has, Marvin has. I use my FX book. That's one I've mastered. Baby Pips has. There's a lot of calculators in Forex has. There are even more that you can even download on Google Play Store and pay for. HFM has their own and many more. But the one I use most times on my phone, on my Android, my iPhone, my laptop is this one. Okay, so for instance, now on our accounts, okay, this is the Euro AUD trade we took. Okay, so now to answer your question, with low capital, does the 1% risk approach apply? Ikejuku and Emmanuel, how do we calculate account size? This is it now. Okay, lot size, account lot size. I know that's what you want to say. This is it now. So I'm answering two questions with one illustration. So on our account on the practice account, our account balance there is $1,115. Is around $115 based on the last profit you made. You made profit of $115 profit. So now everybody's advised to risk. No. Yeah. It's true. Everybody's advised to risk 1%. Okay, 1%. And the stop loss on this trade. Let's go over here. See, this is the stop loss. The stop loss here now is this figure over here. Let me position this like this. Watch out for the figure that will come out here. That figure that comes, that 75 is the stop loss. Okay, and you can see over here the risk to reward is what? I see for 1:2. Okay, so you come over here and or is that 1:3? Then you come over here. So since it's the stop loss is 75, I know where my exit price is. If the market goes down here, I'm ready to lose whatever amounts that I risk on this trade. Okay, I think we risk about $100 and something or so. Okay, so you come over here now and type in the stop loss is what? 75 pips. You should know how to put stop loss. Then you put the this one comes automatically. Then click on calculate. Once you click on calculate, you see here the money you're risking is 11.15. That's the money you're risking. That's 1% of the money. Then the position size, you see the sizing now, it is 0.02. Okay, 0.02. But me now, as per se, I understand my strategy. I would be going for 10. So this is the amount I should be risking. That's 111,005 cents. And this is the lot size I should use, 0.23. That's the lot size we used on this trade, if you guys can remember vividly. So now, that's how you do the position sizing, and we have been able to answer that. Then, what emotions does revenge trading fall under? Revenge trading is its own emotion, whereby you lose money in the market, you instead of letting go of that loss for the day and coming back the next day, you want to place on that trade to make back the loss, you lose again, you want to place on that trade, you lose again, you want to place on that trade, you lose again. So that is it. Okay. So Joshua Atochku says, sir, what about Nash market? I don't know what you mean by that market. NAS. Is it NAS? Is it NASDAQ? Then Emmanuel says, do we do this for every trade? Yes. Emmanuel, you should do this for every trade, because the rule says before you even enter the trade, remember that 3 rules in the beginning. The first rule is protect your capital. You should know how much you're ready to lose on every trade before you even place buy or sell. Every professional trader knows how much they're ready to lose on that trade. Okay. Then the second rule now, the second rule is what? Set your risk, the amount you're going to lose when the market goes against you. Set your goal, the amount of money you're going to make when the market goes in your favor. Okay. Any other question? Okay, so now that we have been able to see how the position size calculator works, which is very, very important and very, very uh, uh, which is very, very important. The next we have in line now is what? You have to fill out the trading plan. Okay, so you have to fill out the trading plan. So an assignment that I added for you guys, which you guys will be receiving tomorrow morning, okay, is fill out a trading plan and submit. That assignment is to fill out the trading. So I'm giving you guys a hint now that the assignment is what? Fill out a trading plan. And I can remember I told you guys to take a screenshot back then. So if you are taking that screenshot, you just easily fill out that trading plan and then submit it as your assignment, okay? And in the points. Then start a trading journal today. So a trading journal as well is something you should start. You can either have an online journal or offline journal. You can have a physical journal whereby you journal your trades on a daily basis, or you can have an online journal. Then practice with paper money. Every single trade we have been placing this week, on Monday, the Bitcoin trade we placed, sell that made profit for us, we place it on practice money. So learn to recognize your emotions. Every single trader is a very good emotional person. They know how to control their emotions. Anger, fear, greed. You understand? FOMO. Every single trader knows how to do that. Every single trader. You can't see a trader that panics anyhow. You can't see a trader that is fearful anyhow. Most traders are courageous, calculated risk takers. Even as they're taking action, they've already they've done the calculation of what is involved, what is to lose, what is to gain. Because what they're going to lose is something that is considerable. In every area of life, they can let go of it, and then they know that the reward is bigger, because all the time their rewards are always bigger. They have already done the risk management earlier before they took the actions. You guys, so learn about that. Learn about emotions. Very, very important. Okay. So let me give you a hint now for you guys that are about to this point. Let me give you a hint. The way you control fear in a trade is what? Know the amount of money you're going to lose. That's why that question that's why that question Ikechukwu asked. No, it's not Ikechukwu. Emmanuel Emmanuel asked, do we do this for every trade? I said yes. Know the amount of money you're going to risk. If you don't know the amount of money you're going to risk and you place a trade buy or sell, you'll be sweating. You'll be sweating. Psychologically, you'll be sweating out and in, and you'll be looking at your phone. You'll be looking at your phone 24 hours. If it is 5 hours that you place that trade, you'll be looking at your phone because you don't know how much you are going to risk. You'll not be like, okay, if it's in reach $200 loss, let me close it immediately. But you don't know that market just wants to go over there, react in a certain way, and move in your favor. You understand? That's where loss come. But once you have done risk management, you've told yourself, this is my stop loss. Once the market gets here, I'm going to risk $100. Even before you place buy itself, you've made up your mind. You place the buy, the fear will not be there. Because based on your projection, your calculated risk management and probability, your projection as in the projection you have made, your plan you have made, the market, even if the market reach, they don't watch, the next trade will bounce you back. The next two trades will bounce you back. The next two trades will bounce you back, depending on your risk to reward ratio. Very important. Risk to reward ratio. Very, very important. So you can be very good with like I told you guys, every strategy is good at the beginning. The first session we had of week 2, someone was telling me, what about strategy? I'm meant to teach strategy. I'm telling you guys, any strategy is good. Every strategy is correct. But what some traders get off is psychology and risk management. They don't get it right. So how to handle fear now is what? Do risk management. Know the amount of money you will lose when you enter the trade. How to handle greed is when the market is in profit. You place a trade, you're risking $100, your target is $200. Like this Euro AUD trade you place now. Earlier yesterday, we made $90 profit. I was looking at the trade. I did not flinch. I did not have that burning desire of let us take this one. No, this market to come and reverse, which it has. You get? So as a professional trader, what I did was I sat down, I started analyzing. I analyzed Euro. I asked myself, is it still possible for Euro to hit my target? That's the question you need to ask yourself when you are feeling that urge of, let me take some money, or that fearfulness of, let me take some money before it will reverse. Okay, so to stick to that plan, that trading plan of risk to reward, you're risking $100 to make $200. Okay, to stick to that plan is very important. One, okay, okay. So no matter after your strategy, no matter after your strategy, probability and risk management is the key, because you still don't control whatever happens in the market. You still don't control what happens. Only what you control is the amount of money you risk on a trade, and then the amount of money you make on that trade. And when you enter, that's what you control is when you enter, the amount of money you risk when you enter, and the amount of money you make when you enter. That's the only thing you control. Then controlling your emotions is not an external factor of what you do to be able to make sure that trade, you keep holding that trade to hit your target. So is that as it. So you need to learn to be a robot. So the way you can control your emotions of taking profit too early is what? Set and forget. That trade I placed since Wednesday, I've looked at that trade only 2 times since I placed that trade with you guys. When did I look at it? I looked at it early yesterday morning. I looked at it early today, this morning. Okay. So set and forget. You set the trade, forget it. Or you can be looking at it every 4 hours interval, every 8 hours interval. Not the one you look at it, you be on trade, you be looking at it. You be telling your guy, you don't give me $2 profit though. Sharp. Then you enter loss. You go to sweat. Guy, this thing don't enter $5 loss. So all those kind of things. You don't need it. It will make we pass through all those things. That's why I'm sharing with you guys. We pass through all those things. And what we call it here, you're marrying your trade. You want to marry the trade. You understand? So don't marry your trade. Set and forget the trade. Set the take profit, set the top stop loss, and leave it. So review your journal weekly. Very important. Review your journal weekly. So I have some questions here. I have someone that asks, sir, our entry doesn't matter in position sizing. Please, your entry matters in position sizing. Let me tell you. Joshua Tochuku, your entry matters in position sizing. Let us say, for instance, now, this trade now. Let me clone it so we don't mess up the one we are on. Let us say now, for instance, now this position, the trade I placed now, I wanted to be very, 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 very accurate, and I placed it at this 90 pips, sure. Then I placed my take profit at 180 pips because 180, 90 times 2 is 180. Bagam. So now come and see now. This trade now is 90 pips stop loss, 180 pips take profit. If you come over here on this position size calculator, and then where they ask you for the stop loss, you put 90 pips there. Then click on calculate. You see that 0.23 now has reduced to 0.19. So it's going to affect. Okay, so the calculator does everything, but it's going to affect it. So and the price at which you enter matters. So I see another question here. Hassan. That's where loss comes. Okay. Okay, Chukufevo says, and that's why a lot of people who start give up or call it a scam. Yeah, they don't practice proper risk management and proper psychology. But Chukufevo says, you did confident too. Yes, experience has actually built me to that level now. I manage multiple accounts, and there's no need me watching one account when, yeah. So it's just experience though. And there's something I do every morning when I wake up. There are commandments I read to myself. The way you have 10 commandments, I have 10 traders commandments. I read it to myself, and that I must follow those commandments. It's just like me writing my own Bible. So I wrote my own 10 commandments and I follow it. Okay, so I can recite it. I've actually memorized it. It's now part of me. So Laman Sano says, what about using trailing stop to secure the gains? I don't use my manner of approach. I don't use trailing stop. I don't use trailing stop. If you're a swing trader, yes, you start considering trailing stop. Okay, I don't use trailing stop. Why I don't use trailing stop is because sometimes it might not work well with your trading plan. I don't use trailing stop. I set my take profit and my stop loss. Once the market gets into my profit, boom, I take it. Once it gets to my loss, boom, I take it. But there are some traders that once the market gets to 20 pips of profit, okay, let me show you guys this. I don't like talking without showing. So let's say, for instance, now this market come over here now. This is when we enter this market, and you see the market went up. It gave us about 50 pips profit. Okay, so now what this guy is saying about trailing stop is that I'll take my this is where my stop loss is, right? I'll adjust the line, I'll adjust it and go and put it here. I'll adjust it and go and put it here. My stop loss will now be here. So when the market now does this, when the market goes up like this, okay, and comes back down, boom, it will close out on 0 profit, 0 loss. My capital will be protected. Then the market goes up like this again, okay, and then goes back down. Now I'm in loss, okay. But let me now show you something. Let's say on this Bitcoin trade we took on Monday together, you're a trader that does trailing stop. Remember our analysis from the Bitcoin fundamental we read, it completed though. It went to 107,000. So if you are taking those trades on Thursday by 8 a.m., I did not look at Bitcoin. Thursday, 8 a.m., yeah, market gave us a sweet sell. So that's 107,000. Let's say this trade, you did trailing stop. Let's say this trade, you did trailing stop. We entered this trade together on this. I think this was where we entered. And the market went and gave us profit. Me, this is where I entered originally in the morning. And I did trailing stop. I went and put my stop loss here. The market will just have come out here and take me out. The market maker does not want you to make money with them. That's why they sell to you market at a premium price. One, they either send you to the wrong direction. Two, or or they just take you out. They take out your stop loss. So this is it. The market will just take me out and go to my direction. And I'll be like, regrets, you get? But once I've placed my take profit and placed my stop loss, I'm working with probability, guys. I'm working with probability. If you want to hit my stop loss, hit it. Let me know you've hit it out. That probability has fulfilled. Yes, I'll take it. The next one that I play, based on I've understood my winning rate. Based on the next one that plays, I always have this confidence of the next one that I play would bounce back. That's just it. Based on you understand what you're doing in the market, you know what you view out for in the market. So stacking is good if you are applying proper risk management. That trade we took on Bitcoin, we stacked, we add 4 positions, but the total 4 positions, if it hits our stop loss, what we are losing is $100. Don't go and stack, and you're saying you're stacking positions, and you went and enter 4 positions, 5 positions, and you're going out of your $1,000, you're going to lose $500. No, that is not good stacking. You've just lost 50% of your account. That is Joshua Tochukwu. I'm telling you now. So if you're stacking, stack is good, it's fine. Stacking is meant for what? Extending profits. If the market starts going in your direction, instead of placing 1 position, you place 3 positions or 4 positions at a particular price. So that when the market goes to a certain amount, like 1:1, you take profit. If it goes 1:2, you take profit. If it goes 1:3, you take profit. And the last one, if it goes 1:4, you take profit. Now check it out. Let me now tell you, you guys that do stacking, add up the total profit you made when the market did 1:1, 1:2, 1:3, 1:4. Add it up. You see that if you had just done 1 trade, you just place 1 trade buy and did 1:2, the total money you made waiting for 1:4 on your stacking would be made at 1:2 on 1 single trade. Mathematics, please. I have experienced something in this market. So it's best me, I place 1 trade, I make 1:2. I know that I've made my $200. Then I go and stack. I add 4 positions. I wait for it to go 100 pips. When you go 100 pips, if you add everything up, you make $200. But me, I've already taken my $200 at 50 pips. Does it make sense? That is what I'm trying to let you know. Stacking is good though. It's good. But use sense and stack the market, you understand? Because still on still, if you stack and the market goes against you, what you're going to lose is $100. But if you stack and you do break it, because most times people that do stacking is when you make 1:1, make 1:2, you go and do break even. You take your stop loss and put it at your entry. You understand? When the market now goes against you, you enter at loss, 0 loss. You understand? But the money you must have made must be $50. When you enter the next trade, you now lose $100. You see that the $50 you made before does not even make sense. You get the point? So that's why I like this approach. Set and forget. So the thing there is I wanted to show there's another Omo. This is that what people call break even. Okay, yes, Taigo. That's what people call break even. To take your stop loss and put it at your entry is called break even. So Forex compound calculator, Forex. The next thing I want to share with you guys is the compound calculator. Very important to help you with your trading plan before any other thing. Forex compound calculator. There's a particular one I use, not this one. I think it's this one. This one, the calculator size, Forex compound calculator. Okay, so you can also use Forex. Yes, this is exactly the one I use. So okay, so let's say the starting balance of our account we started with is $1,000, which they gave us, and our monthly compounding, like this month I made 200%. But let's just say as a newbie, you can aim for as low as 5%. Then years, how many years do you want to compound this account? Give yourself 5 years, okay? And then let's give yourself 5 years. Then compounding monthly. Okay, compounding this 5% monthly, daily, weekly. Let's make it daily. Let's just leave it a year, or let's give it 2 years. Are you adding any additional capital to the money? No, just calculate. It's going to bring out, and this is something you can even print. This is something you print and keep it on your room or on your trading decks. So for the next 2 years, you're going to be coming out with what? 3,225.10. Okay. So you tell yourself, okay, next 2 years, I want to buy this, I want to buy this, I want to buy this. How much is it going to cost in dollar? You divide it, change the naira to dollar. Then you come over here and plot it. Okay, next 2 years, this is what I'm going to achieve with Forex trading money. I'm putting in what? $1,000. And for the month of November, I'm going to make just $50 of this account. If I make $50, I'll stop trading this account. Okay, We just made $100 on Monday alone with $1,000. So if I admit it, I will choose. I don't trade November and December again. I will rest because you see, our target for November and December is what 110. But so there are people that really want quick money. You can actually choose to make 10%, and this 10% is done weekly. I can easily do that. 10% is weekly. You understand? Then for let's say we do that for 5 years, then we calculate. So if you do 10% every week for no, that's the way I did that stuff is too much. Let us do it for 2 years, please. Then do calculate. Good. So 10% for 2 years. At the end of 2 years, we're having $5 million by compounding 10% weekly. So every week when it comes to the market, 10% trade is what you're looking out for. 10% trade. You can just reach 10% of the account to make 10%. Once you hit it, you're good. If you lose 2 trades in a week, you're done. You've lost 20%. You understand? But if you win 1 trade in a week with 1:3, you bounce back from your 2% 20. Don't worry. But the thing there, this compounding calculator, then you can come over here and download it. You can start over or download it. You can save it as well. On Pinterest, you can download the stuff. You can make it a table. You can make it a chart. This is what I use. Okay, you can download it. So thank you so much for